I think we're about ready. Ready to start? Close to. Welcome back. My name is Dusan Stojanovic. I was the Chief Risk Officer with the Federal Home Loan Bank of Des Moines. We are a financial services company, member-oriented, serving insurance companies and banks and other financial institutions for over 100 years. So insurance company is a big, big part of our business. I'm here to introduce Gary Zhu, who's going to be talking about economic themes impacting insurance. I am part of the steering committee for this forum, and I was just looking at some notes, things we've handed over to Gary early on to prepare the particular themes, and they're kind of dated. One of the bullet points says, "Is the low interest rate environment over, or is it here to stay?" And I've looked at, just wanted to see how far back this goes. I think rates started increasing in March of this year, so it wasn't that long ago. It was about 5 rounds of rate increases, and look where we are now, and who knows where we're going to be. So I'm sure Gary's going to be talking about that a lot. This theme is also near and dear to my heart because I am a recovering economist as well. Without further ado, I want to introduce Gary. Gary Zhu is Senior Vice President and Director of Insurance Portfolio Management, responsible for AB's fixed income insurance business. Prior to that, Gary was senior with Wells Fargo Securities as well as Genworth, and he can maybe tell us a little bit about that progression. Gary holds a BS, summa cum laude, in finance and economics from Virginia Commonwealth University, and an executive MBA with Dean's Honors from Columbia Business School. He's also a CFA charter holder and holds the Fellow Life Management Institute designation. And with that, I'm going to turn it over to Gary.
Great, thank you so much, and thank you so much for having me here. Similar to Pujol, I lost my voice as well last night, so the allergy thing here is real. But it's funny that I actually grew up in Richmond, Virginia, and just as a trivia, that Richmond, Virginia, it's actually the second worst city for people with allergies. Don't ask me what the first is. Like, I didn't care at the time. All I knew was that Richmond was the second worst, and I would have thought that by now I have built up an immunization system, but apparently not. So apologies for my voice. I sound a lot better in no more times. But nonetheless, thank you so much for the introduction. And again, thank you so much for having us here today. I also have my colleague, Melissa King, with me in the back. So AllianceBernstein, it's one of the largest insurance asset managers, not really known to the insurance world, unfortunately. Part of the reason is that we have really never actively trying to go out there and seek insurance assets. But our history with the insurance industries goes back way back in times before I was born, actually. So AllianceBernstein is 2/3 held by Equitable Insurance Company, and Equitable went IPO in 2018. And before the IPO in 2018, Equitable used to be a part of AXA Insurance, a French insurance company. And within AllianceBernstein AB, 1/3 of our fixed incomes AUM, it's for insurance assets, and about 1/6 of the total firm's assets are dedicated to insurance clients, including the fixed income side that I run, the equity side, and as well as multi-assets and private alternatives that my colleagues run on the other side. Dusan asked me to share a little bit more about my career progressions when I was at Genworth for almost a decade, and then at Wells. I guess if we go back in time, start with Wells. I ran Wells Fargo Securities cross assets franchise for about 5 years before I left, and then prior to that, I was a portfolio manager and trader and also credit analyst, spending various time at Genworth, which back then it was actually part of GE Financial Assurance. Um, and that's kind of my connection with Richmond, Virginia, because that's kind of where the insurance headquarters were at the time. It's was in Richmond, Virginia. So I do have a couple questions that was sent to me ahead of time, but since interest rate seems to be something that is nearest and dearest to a lot of folks' heart, happy to go right into that, and feel free to interrupt and ask me questions if you have. And like by no means that I have cracked the code, right? And like heading into the year, I think I've been more bearish than my peers and economists in terms of where we think interest rate can go. I never believed in the term transitory for inflation. The reason really being is that like I use myself as an indicator. Heading into the years, and I guess for what it's worth, I'm a big believer of McDonald's. I actually love McDonald's so much that I usually go once a week. Big Mac #1 meal is something that like I love, right? Like in 2021, I was going to McDonald's once a week, getting Big Macs for like $6, like for the whole meal, including the drinks. And then very quickly in late 2021, I'm starting paying like $7 or $8, and in 2022, I'm starting paying like $8 9. The way that I think of myself is that like it's really easy for price to go up, but it's really hard for price to fall back down. So it's given the stickiness of it, I never believe in the term transitory. If there's anything that I think, if I look back, perhaps one thing that we should have done, we should have done more, perhaps to be even more bearish than when we headed into the year. We thought 10-year can get to 10. I'm sorry, we thought 10-year can get to 3 and 3.5. We didn't see a 4%. We definitely didn't see it in 2022. And I think that kind of speaks to the point about being nimble and forecast often. It's basically what I'm telling my team at AB is that we got to be nimble. We got to be challenging ourselves from a status quo perspective, right? What are we missing? I think earlier panels talked about like what are some of the risks that we're not talking about. Another thing that I challenge my team is that maybe there are risks that we talk about, but it's underappreciated. Inflation was a risk that we talked about, but I thought it was really underappreciated in a sense that no one really thought about, or at least being challenged enough to think that what if we're wrong? What if inflation would stick with us longer? And what if that would push the Fed to increase interest rate a lot more? The Fed has already done 300 basis points of increase in interest rate. And heading into the November meeting, at least 50 basis points or 75 basis points already kind of baked in by the market. The question really is that from this point on, where do we go from here? Like from an economy perspective, if we use the traditional definition of a recession, right, 2 consecutive prints of negative GDP growth quarter over quarter, technically we're already in a recession. Now I get it. We have to wait for the National Bureau of Economic Research to actually call recessions, but knowing them, they're not going to call it until we're probably going to be out of the recession, right? Just like in 2001, the National Bureau of Economic Research said in September of September or October, I forgot. But anyway, so they came back and said, whoops, we missed the print, and apparently we were in a recession. So the difference, I think, this time around versus last time is that in addition to the economic growth that's being slowed down, the labor market has held up meaningfully. I forgot who's the person that would ask about where did the labor force goes, right? Like it's hard to believe that if we're in a recession environment, the unemployment rate it's only at 3.5%. And I think a huge component of it, it's the fact that labor participation is extremely low relative to what we have seen in the prior cycle. And that kind of really started about 10, 15 years ago, right after the great financial crisis, is that like labor participation has gone down from the 70% to now in the low 60%. A lot of folks, either due to immigration policies or due to the fact that are no longer willing to wanting to work in the workforce, has really contributed to this periods of really tight labor market. So heading into the year again, that we'd be more bearish than our peers on rates and also the economy. And now we felt like that we're more on consensus in terms of like where everyone thinks that the trajectory of rates can go. I think some of my colleagues are calling for like 4.25 in 10 years, which the dangers of putting forecasts out and traveling in a week in a very volatile environment is that like my junior PM was texting me today that apparently we're already at 4.26 on 10-year. So forecast often. That's basically what I'm trying to say is that being out in the office for a week and the next thing you know, 10 years are at 4.26%. Another thing that's interesting is the curve, right? That if I think about the 2-year U.S. Treasury versus a 10-year U.S. Treasury, today the 2-year U.S. Treasury is sitting at about like 4.5%. So the curve basically is inverted by about 25 basis points. And that is very challenging for a lot of investors to try to think through, right? Is that like your curve is inverted. So do you want to take on the reinvestment risk and staying short and buying something that's 2 year, or you want to lock in your 4% return or 4.25 yield on the 10-year part of the curve, but in anticipation of further rates increase, which from a bond investor perspective, high interest rates means lower dollar prices for investments. So those are the things that we debate all the time within our firm and also within my team is that as a investor for insurance clients, a combination of rates and spreads are something that is bread and butter to what we do on a daily basis. So let's see what else. I'll pause here for a second, just see if there's any questions or challenges to the view that I just gave. Hang on, Stuart.
With the increase in rates, you see, where do you see the balance of flow of funds between public and private assets? Insurers have plowed a lot of money in private assets. How do you see that changing with the new prevailing level of nominal rates?
Yeah, I think that's a good question. That's something that we debate all the time. So like earlier this year, as we're thinking about like the theme for insurance investing this year, one of the themes that we said is this is a comeback for public fixed income in our minds. That finally, for the longest time, interest rates is no longer sub 1%. You're actually buying a credit, IG credit, in the 6% yield. The way that we're trying to think of it and how we manage our portfolio for our clients and also advise prospective clients is that it doesn't have to be binary, meaning that it doesn't have to just stop buying or stop allocating to private assets. But what we urge our investors is that like the required rates of return on private assets to me has to be meaningfully higher at this point, right? If you used to earn about 20% returns on a consistent basis on investment on IRR for all of your private alternatives, whatever the case, whatever investment that is, the fact that now public assets, it's now at 6%, 7%, that basis has compressed between privates and publics, which then, in my mind, require a higher rate return for private alternatives. I still see private has a seat or has a place in a total strategic asset allocation because it does provide diversification benefits. It does provide assets risk to another sector, another geographic region, or other type of risks that you couldn't get on the public side. But I do think that the required rate return has to be higher. In addition, I think this is the first time that insurance companies are dealing with humongous amount of unrealized losses in the portfolio that has nothing to do with credit losses. Unlike the great financial crisis, a lot of insurance companies are sitting in huge unrealized losses from a spread perspective. But because the rates were going lower and lower and lower, from a total unrealized gain losses perspective, it was actually pretty manageable. And I mean, all of you guys are expert here. You don't need me to tell you about the fact that for life insurance company, when you take gain losses, assuming that you have enough balance on your interest maintenance reserve, you get to amortize your gain or losses for the remaining life of the bonds. But that argument no longer hold true when you have depleted all of your IMR, interest maintenance reserve, and then at this point, any incremental dollar of losses that insurance company take will be a dollar to dollar hit to surplus, which affects the insurance companies, operating companies' ability to dividend up to the holding company, which then affects the holding company's dividends to the policy to the equity holders if you're a publicly traded companies, or to your policy holders if you're a mutual company. So taking the two and two together, I think the argument for public assets should be a lot higher, and the demand for public assets will likely be higher than private assets due to compression margin between the two asset classes and also the potential need for liquidity in a rising rates environment. Great. So the original question was that, like, is the low interest rate environment over or here to stay? So the way that I try to think about it is that, like, what drove interest rate to being so low earlier on in the past decade and a half, right? I think part of it is it's global central bank interventions. When you have the U.S. Fed only about a third of the outstanding U.S. Treasury, and Japan BOJ only about a third of their outstanding JGB issuance, as the biggest buyer who are agnostic to dollar prices, I think that's part of the reason that was really capping how high yield can go. from an interest rates perspective. And if we're heading into environments that central banks are becoming more tighter in its monetary policy, and at a point that potentially they are letting the portfolio roll off, and they haven't talked about potentially selling outright of the treasury positions yet. But to me, that's one of the risks that like investor has to consider from a range of outcome perspective. I don't think anything is off the table. Like if it's anything, I think in my mind, like I guess it's caveats, right? It's easy for me to be in a cheap seat and comment on what I think the Fed should do or shouldn't do, but you know, I'm very opinionated. So what the heck? So I'm gonna give my opinions anyway. I still believe that this is the perfect time for the Fed to try to take some of the position down outright. Like they're already jacking up interest rate that high anyway, and pushing tighten financial conditions. Why not use this opportunity to sell down or let a bigger portion of the treasury and mortgage-backed securities book roll off, right? Reduce the size of the Fed's balance sheet. Now, I get it. The book is now sitting on huge unrealized losses. To remain Fed's independence, likely the Fed does not want to go to the Treasury and say, "Whoops, we are now taking huge losses in the book, so we need the Treasury to write us a big check." So I get all of those, but again, like given the fact that I'm opinionated and I'm at a cheap seat, so I felt like I'm compelled to give my opinions on what I think the Fed should do. I was at a meeting earlier that someone reminded me that there's a fine line between what I think the Fed should do or what I expect the Fed would do. So I still don't think that, as much as I would love for them to reduce the assets, doesn't seem like there's this consensus view on they would do that in the near term. Anything else? Just thanks. Question. There you go.
You just spoke about what you would do if you were the Fed going forward. What would you have done over the past year, 2 years, 5 years, if you were the Fed then?
So if I think back to the pandemic, right, like in March, I still remember exactly when the Fed called the emergency meetings, right? It was March 13th, 2020, when the Fed called the emergency meeting, and then they met again. And that was 2 weeks before the scheduled FOMC meetings on March 20th, I forgot, 21st, 22nd. If we start a clock from that day to up until this point, I think I would have done exactly the same thing the Fed has done. From a decision-making process perspective, one thing that I think I would have done a better job, and it's kind of sound funny or hypocritical from coming from me, is that I think it's the communications. The Fed has changed the way that it's communicate to the investor or markets in terms of what they think their monetary policy setting standards are. It went from a forecast-based Fed to an outcome-based Fed, right? So a year and a half ago, the Fed's fight against inflation, or the Fed has two mandates, right? Price stability and the labor market. It went from a forecast-based Fed targeting a long-term inflation rates to a outcome-based Fed, meaning that like we're going to fight it, we're going to do everything based on what the data is telling us. But that's really hard to stomach because now you corner yourself, right? What if inflations continue to be sticky? What if the data is telling, what if the current data is telling you one thing? What if you now expect the future to be very different? So I think perhaps it's one thing that they could have done a better job is sticking on course from a communication perspective on how monetary policy statements are made. But again, like I'm at a cheap seat, right? So it's very easy for me to tell them what I think they should be doing. All right. So another question that I got earlier was that like we should discuss about how carriers needs to be prepared for a ever-changing economy, society, environment. And I think some of this has been covered by the earlier panel in terms of like from angles of ESG. And at AllianceBernstein, the way that we think about ESG risk, we treat that as credit risk. And managing credit risk is not something new to the insurance industry. Like insurance company, for example, right? A huge balance sheet from an asset side that is allocated to commercial real estate. Insurance company allocates anywhere from a single digit as a percentage of total portfolio to like a quarter of the total asset books are in real estate related exposures, including commercial real estate loans, commercial mortgage-backed securities, and mortgage REIT on the on the corporate credit side. And environment, the E components of it, is something that like we take into consideration as underwriting credit. And same thing can be said for the S component and also the G components. In our mind, in managing ESG, the most important thing really is that like be honest about, be transparent, be honest about what you are and what you're or not. So we spend a lot of time cobbling data and trying to provide transparency on what we do on the ESG front as we manage and credit risk for our portfolio. In addition, besides changes in the economy, society, and environment, regulatory changes, I think someone that we talked to, unfortunately, Andy couldn't make it at this time, but I think, Kevin, you said Andy will be on later on, right? Perfect. So there you go. So at 2:30, you guys should ask a lot more questions on the regulatory update side. Just on a side note, I went from having a sessions right after lunch when everyone is happy to now that I'm standing between you guys and lunch. So I'll remind Andy that I'm taking one for the team for him. So, but nonetheless, kind of going back with a environment that is ever changing. Thing that we always advise our clients and also the way that we manage our portfolio from an asset side is that we think heading into periods of volatility, you really have to remain limber. You have to remain agile, and you also have to keep a pretty high liquidity profile. And then stay invested. The worst thing you can do is try to time the market. At the end of the day, for a guy who manages insurance assets, like picking the perfect time to enter the market or picking the perfect bonds to outperform 5 or 10 points, it's just not my game. And I'm very transparent, honest about it, right? If I'm right on every single trade, I wouldn't be sitting here, right? Working for the hedge funds or elsewhere. It's just not the right trade for insurance company, in my opinion. And insurance company management, in our mind, is that build a diversified portfolio that meets the insurance client's objective. Let it be liquidity, let it be returning capital, let it be income that the insurance company is looking for. And really trying to avoid like large idiosyncratic risk that can tip the portfolio. One thing that we proud ourselves heading into the year was that in the insurance portfolio that we manage, we have zero exposure of Russia and Ukraine heading into this time. Not that we foresee Russia was going to invade Ukraine, but just from an investment thesis perspective, the question is not if but when. I mean, for what it's worth, Russia had already annexed Crimea heading into this, right? Like, what stopped them from doing more? It's just not an idiosyncratic risk that anyone can model in my mind, and it's just not a right investment for insurance companies. And that's kind of how we advise and manage our portfolio for a client is that build a diversified portfolio, try to avoid idiosyncratic risk, and preserve capital and earn incremental return over time. Last topic is really to keep looking for areas of underappreciated risk. There's a lot of risks that we all manage on a day-to-day basis. Let it be interest rate, let it be credit risk, let it be cyber attacks, whatever case it might be. In addition to asking the unknown question, which is really hard if I think about it, right? Like if I know where the unknown is, then I would be able to address it. So we don't spend too much time trying to think for the unknowns. We're trying to look for areas of underappreciated risks. So in that way, at least we can position a portfolio appropriately heading into the down cycle. Which lead to another question that was given earlier, which is that how would this business cycle impact the supply of capital and the demand for insurance product? So looking back in history, right, historically, capital markets liquidity tend to drive up when the markets move along the business cycle, especially in between the late expansions and early contractions phases. And this is exaggerated by the fact that this is at the same time that US Feds and global central banks are trying to withdraw liquidity for the market. And that's probably one of the reasons that you have seen credit spreads has widened out meaningfully this year. And at the same time that rates were backing up. Over the last couple of months that we saw spreads widen at about 25 to 50 basis points on the more higher quality assets to anywhere from 50 to 100 basis points lower down the capital stack that on the assets that we manage for insurance company. Many participants argue that that is due to the fact that now the market is pricing in a higher risk of recessions. We have different opinions. I would argue that the market has not priced in a actual recessions, but the market right now is pricing in for the wider spread. It's pricing in a wider range of outcome, meaning that the likelihood for recession is high. No one knows the magnitude or the timing of it. But at the same time, because of how tight the labor market is with a 3.5% unemployment rate, there's still a potential upside if and when rates stabilize. So from a thought process perspective, if the spread widening is driven by a wider range of outcome, and if the Fed is data dependent, then investor will likely be data dependent as well, meaning that any future negative prints on either the credit fundamentals, consumer fundamentals, or economics would then lead to further spreads widening. And at least we wouldn't rule that out as a possibility. And from that point of view, basically what we're arguing is that the cost of capital has increased or should continue to increase. And those that do not rely on heavy debt financing will likely have an advantage over those who rely heavily to tap the credit markets. Now, the vice versa is true, right? For those insurance company who has positioned defensively headed into this recessions, then likely they will be able to come out a lot better because of the fact that now they have dry powders to invest into a higher yielding and wider spreads assets and take more calculated risk than those that had already loaded up their risk budgets. And turning to demand for insurance products, like I think insurance companies will continue to be innovative. Now, this is purely from a pedestrian's view, right? Like I manage insurance assets on the asset side. On the liability side, something that like I spent a little more time when I was actually working in an insurance company, as a manager. I don't really get to spend time on the product side. But no one in insurance company, like you have price and actuaries, you have like product innovation teams. All they do all day long is trying to come up with new products that can service their clients better. And I think after this pandemics and after these recessions, new products will come out. And those who continue to spend monies on innovations, spend monies on come up with new products, will likely come out ahead of others. I'll pause for a second.
Economist here, not ask about sovereign debt and what your view is. Last time I looked at the U.S., for instance, it was 290% of GDP if you rolled public and private. I think many parts of Europe are well over 300. How do you factor those types of things into your models when you're looking at a forecast?
I think back in 2011 that during the sovereign crisis, European sovereign crisis in 2011, or even during the periods that when the U.S. debt from both on the public and the private side as a percent of GDP has really escalated. Nothing is really safe from that perspective, right? Especially for insurance investors, NAIC ratings is super important, which is dependent on the nationally recognized statistical organizations, NRSRO. And in 2011, August of 2011, I still remember that day, and S&P downgraded U.S. from AAA to AA, right? To me, that is a real risk. Not only in the U.S., if you compare to what's going on in UK, right? Like in the whole confluence of like the developed markets rates, I have never seen in my career, and I think a lot of my peers have never seen in their career that UK rates can swing in the 50 basis points upside and downside in a periods of one day. Like we are in the periods that developed markets rates are trading like emerging markets. So no, that's part of it. You can argue that's just the markets tend to overreact. Fine, I get that. But I do think that we're in a period shifting from a long periods of easy money where the Fed has become or global central banks has become the backstop of the public debt market. And I think we're shifting away that. In terms of how to translate that into our credit model, the way that we're trying to think of it is really the range of outcome. I'm not a binary guy because it's really hard to pinpoint and say like, if A happens, then I expect B happens. I like scenario analysis. The beauty of scenario analysis is that if I can come up with enough scenarios and think for the range of outcomes, then I can come up with portfolio constructions mechanism or portfolio constructions that works in each of those scenarios. And then I can know that what is my trade-off. At the end of the day, nothing is free. I can build a treasury-only portfolio. I can build a T-bill-only portfolio. The question is that what am I giving up? Through scenario analysis, through stress testing, what it allows us to do is to come to analyze the portfolio constructions and the portfolio outcome in each of those scenarios in that range of outcome, and allow us to manage the portfolio through the different business cycle. So to answer your question directly, it's the range of outcome. What do we think the potential range of outcome is from a rating migration perspective? And it's less so important on the developed market, but more on the emerging market debts that we model is that what's the likelihood on some of the hard currency EM debt that we invested in that you're not going to get your money back due to either both the willingness to pay or the ableness to pay has diminished or declined meaningfully from the time that we actually purchased this security. Great. another question that was given to me earlier is that how will millennials and Gen Z insurance need different from the Gen X and the baby boomers? Again, this is from a pedestrian's view, right? You ask an investment guy to comment on what I think of like um, the insurance product should be selling. One thing that I keep thinking to myself is that like, what is the difference between me and my cousin who's a few years younger, right? I think one of the major difference probably is the percentage of income that we save on a monthly basis. And there are enough studies that has been shown that like Gen Z tend to save more than the prior generations. I think that has to do with the fact that a lot of them actually were young enough or old enough during the great financial crisis that saw their parents lost their jobs and saw their parents lost their house or like cars or whatever the case it might be, that a change in lifestyles has caused them that wanting to save more and build up more wealth through saving than the prior generations. And if you have to think about what that means for insurance companies, then perhaps this is a potential tailwind for annuity writers, that folks who or insurance policy that has a savings components or investment components to it. Now, given the fact that the Gen Zs has actually saved up more money that they look to invest. Again, this is just from a pedestrian's points of view in terms of like how they would differ. Another one is that, excuse me. Another one is that potentially the need for long-term care insurance. The reason I'm thinking about that is that like Genworth actually, when the two companies that I used to work for, they were one of the largest insurance companies provider for long-term care insurance. And over the past couple of years, one of the strategies that they've been employing is to continue to go back to the states and ask for rates increase, right? I don't know if any of you guys actually have long-term care insurance, but basically what long-term care insurance does is that if and when the policyholder can no longer satisfy one out of the 6 living criteria, then the healthcare insurance, the insurance will cover like all the expenses related to taking care of the elder. So as a policyholder over the last couple of years, I have seen I was given the option to either increase my monthly premium or reduce my benefits. So as a youngster, someone who's thinking aloud and say, well, if my cost is going to continue to go up for my policy or my benefits going to continue to go down, then why buy that insurance? Why not just invest that money myself? And perhaps I will have enough to cover my living expenses by the time that I need that insurance. So again, this is purely from a pedestrian's view that like I'm thinking out loud and talking out loud. That usually doesn't serve me well, but again, I'm very opinionated. What the heck? Sure.
Did you do the analysis of the increase in cost in long-term care versus the investment income? And I'm assuming you came out positive the other way?
So I'm a big believer that like, so the short answer is yes. And let me answer like the prior question first, and then I'll answer your question more directly. The challenge with long-term care insurance is that the assumption that you have to, there's multiple assumptions you have to make, right? And you have to be right on every single assumption as a company who sold the policy. So for example, because like the people who buy long-term care insurance are probably in their 40s, 30s, 40s, 50s. And assuming that we all live a healthy life, right? Don't go to Big Mac, don't eat Big Macs, and do salads, then perhaps you will live longer. And if you do, then from the time that you will probably need a long-term care insurance, probably in the 80s maybe. So you're talking about like 30, 40 years of potential investments. From an investment assumption perspective, you're figuring out what investment can you make over the next that many years that can give you enough return. So that's on the investment assumption side. Then you have to make an assumption on how long I'm going to live by the time that I get to 80 and start clipping the benefits. And then you also have to make that assumptions on what is the healthcare cost it's going to be by the time that I'm 80, which is 30 years from today. When I think about all those assumptions that as an insurance company have to make, getting one of them wrong is bad enough. If you get any one of them, more than one of them wrong, like you're really in a negative or challenging environment from that perspective. And I think that's probably one of the reasons that insurance carrier have to keep going back and ask for a higher rates increase. So when I did my analysis, again, based on all those assumptions, the required rates return on a compound perspective, it's about 15% return to kind of account for the inflation, account for healthcare costs, and whatever the case it might be. But again, just because there's so many different assumptions that you have to make for those, it's really hard to say that like, am I going to be right? Am I going to be wrong? So I think as an individual, now if I take a step back, right? Okay, that's from a company perspective. Then if I'm as an individual who wanted to buy long-term care insurance or put my money aside and invest, and the question I want to ask myself is that, then do I want to buy the insurance today when I'm in my 30s? Or do I want to buy the insurance when I'm 50s? So then therefore I can do a better job assessing the money that probably would need to buy long-term care insurance. So my comments earlier was more about like as a younger person, perhaps my entry point can be delayed to later. It's part of the thing that insurance companies tell them is that like it's better to buy insurance when you're younger because the cost is lower. That's true. But if when I'm 50 years old, you start jacking up my premiums, then suddenly the trade doesn't work out too well for me. So that's kind of my thinking process. Did it answer your questions?
Thank you. Yeah, you're too young, I think.
Yes. Great. Another question that was given to me was, if we talk about like insurance products really outside of my expertise, this one is really, really outside of my expertise. We're talking about drought, floods, and hurricanes. Do they create demand for insurance or stress in the system? The way that I think about these questions, right, I think it really drives back to the point about ESG risk is real risk. That the things that we have seen over the past year, like the thing that I keep hearing, right, is that, oh, this is 1 in a 500-year event, this is 1 in a 1,000-year event, and then next year, this is 1 in a 500-year event, this is 1 in a 1,000-year event. Now, I get it, statistically, just because you have 1 out of 500 events on the first day doesn't mean that you're not going to have it again. I get that. But just as a human being living in this beautiful Mother Earth, right, the fact that we have this many 1 out of 500, 1 out of 1,000 events, like I hope it's ringing a bell to other folks in terms of like embracing ESG. So again, from my perspective, I think ESG risk is real credit risk, true business risk for insurance company, also investors. And personally, I will embrace ESG. Again, this is from a perceptions view. So happy to open up more questions. We can go off script as well. That's totally fine.
Any questions?
I see a hand up.
There we are.
I think you mentioned China as a maybe underappreciated risk out there. When I think about China, our economies are so intertwined, and it's difficult to isolate and say I want no China risk in my portfolio. Unlike easier to do with Russia because so many of our companies have supply chains there and manufacturing there. How do you think about China and how do you hedge your portfolio for that risk?
It's really tough. We ask ourselves that question all the time, right? Like 5 years ago, or even like 3 years ago, perhaps the question about China, is China even investable, was never on the table. Over the past 12 months, like internally, we discussed more about, is China investable? Not only in today's world, right? But let's say 5 years down the road or 10 years down the road, because we're trying to take a more longer term view. Again, at the end of the day, insurance company investing, and it's more about investing for the long term. We're not trying to pick a trade here and there for the near term. So the way that we're trying to position is really diversifications. We're trying to stay away from those entities that we think has a huge risk to potential sanctions. We're trying to avoid those entities that like we think that can potentially be viewed negatively if the tensions were to really increase between the two nations, China and the US, and build a diversified portfolio in our emerging markets portfolio. Now, from an investing perspective, emerging markets makes up roughly about 2% on average about insurance companies' asset allocations. You have insurance company that has zero exposure to EMs, or you have insurance company that have about like 6 to 12% exposure to emerging markets. But those that has a larger EM allocations, I think those are the ones that will have a harder time to stay away from Russia. Because if you think about insurance company asset allocation, right, it's mostly investment grade. So then by definition, Africa is out. And if you're trying to avoid Russia and Central Europe that has those kind of neighboring country within Russia and exclude China, then by definition, you've forced all of your allocation to LATAM, which then go against your point, my point about diversifications. So for those larger insurance, for those insurance companies that has a larger EM allocations, I think they're going to feel the pain. In our minds, perhaps the way to manage the EM allocation is to keep a smaller allocations. A smaller allocation allow you to, even though you have a higher concentrated risk in certain geographic regions such as LATAM, but then because the fact that it's such a small percentage allocation to your portfolio that allow you to do a smaller position size, then you can still dabble into China in the near term to take advantage of some of the wider spreads and build a diversified portfolio. But yeah, to answer your question directly, it's a topic of debate that we discuss internally a lot. And then right now, that the way that we're investing is that we're trying to limit the incremental allocations to China. We're not flat out selling because we still think that from the day that they become uninvestable, it's still so far out that we shouldn't sell ahead that far in advance of that event risk. But it's definitely a risk that we're in the back of our head.
Any other questions? People are thinking I'll throw in one myself. This kind of ties into what Brent opened up the previous panel with, known unknowns, unknown unknowns. You were talking about scenario analysis earlier on. Can you share a little bit about how you stress your portfolios? In other words, share a little bit about what the knobs are and how far do you turn them in order to gauge what's prudent and what's not?
Are you asking me to share my secret sauce? No, happy to do that. So we stress the portfolio in two different ways. One is from a market price perspective, right? Using historical scenarios. Like we all live through periods of volatility, and even if we have not lived through those, there are enough textbook that talks about what happened in the 80s, what happened to the Mexican peso crisis in the 90s, what happened into the long-term capitals crisis in the late 90s, and then the Asian financial crisis, and then the great financial crisis, and etc. So part of it is just from a market valuation shock perspective. If we were to live through those periods again, what is our current existing holdings from a price depreciation perspective would correlate to those market environments. And that's one way for us to kind of look at the risk positioning. Because at the end of the day, like this 2022 is actually an interesting year, right? Everyone is losing money from an asset management perspective. The point about losing money is that it's okay to lose money as long as I don't lose as much as my peers. So part of that stress analysis is looking at like what is our portfolio compared to our peers, compared to our index, and compared to historical time. And now we're building a defensive portfolio enough with trade-offs relative to what we have gone through in the past. So that's more from a market value stress perspective. We also do stress on a fundamental perspective. And this is part of the range of outcomes analysis that we speak. So for our credit analysts who underwrite corporate credit, each corporate credits that we buy into the portfolios were underwritten in a range of outcomes. In the base outcome, in the upside potential, which I try to ignore because as a credit guy, I never believe in upside. And I'm a very positive person. I've been called one of the most positive credit guys out there. And then two stress scenario. What is a stress and what is a tail scenario from a fundamental perspective, where our credit analysts who underwrites to a decrease in earnings, compressions in margins, and as well as an increase in leverage through the different economic times. And the same thing for a tail case scenario, where most of the time we're using the great financial crisis as a period of stress, not only from a magnitude perspective, but also from a time perspective, right? Like, it's funny that I was talking to some of my junior analysts, and when we talk about the crisis, they were like, oh yeah, like the March 2020 crisis. I'm like, dude, March 2020 is not a crisis. It was a blip. The actual crisis that we saw last time was a great financial crisis, where it was like 2+ years of like negative. Everything was negative, right? Like people were losing jobs, people were losing their homes, and not only in the U.S. but everywhere in the world. So, but nonetheless, so to answer your questions, right, both a market valuation shock perspective, kind of see where we can tap liquidity by the time that we need, and the other one is from a fundamental perspective, which we always do by the time that we actually buy the bond.
So a lot of the people I follow are already talking stagflation, which I don't think that's in the cards right now due to the employment, being pretty strong. At what point would you be more concerned with the unemployment rate going up? I mean, again, in your models, you have to be looking at that kind of thing, but I think stagflation's not off the table right down the road, but I don't think we're there for a while. But what are your thoughts around stagflation versus inflation versus deflation?
Yeah, so stagflation, I would argue a little bit differently. So I would argue we're the textbook definition of stagflation, we're technically there, right? Stagflation is defined as negative GDP growth followed or at the same time that you have high inflation. So I think from that definition, we're already there. But if we want to use unemployment rates or use the labor market as to substitute GDP, then yes, you're right that we're not there from a stagflation perspective. The thing that worries me is that, or let me take a step back. Compared to, for what it's worth, right? Like I'm a macro nerd. I love macroeconomics, so I spend a lot of my free times reading about economic research and doing data analysis myself. Which my wife reminds me that now I have a little girl that I should spend more time playing my girl than to read macroeconomic books. But nonetheless, so one thing that I like to look at it's the not at the national level, but at the one level down on the income cohort level. The primary difference this time around versus the great financial crisis is that during the great financial crisis, the lowest income cohort, if we were to break income earnings into 5 different quintiles, right? The lowest income cohort of folks in the US, it took them about 5 years after the financial crisis to kind of get back to kind of where they were in the 2004 and 2005 range. It took them 10 years to get back to where the peak was earnings in 2006 and 2007 from an income earning perspective on the nominal basis. Forget about inflation. I get it. Back then, inflation was like 1.5%, 2%. Who cares? Now, if we look at this time around, the interesting thing is that the lowest income cohort folks actually had an uptick in wage inflation. That is data shown that in 2019, 2020, haven't looked at it yet in 2021 yet. I don't think it's out yet. Is that wage inflation has actually gone up to about like 10% or 20% for the lowest income cohort folks. And wage inflation can be sticky unless you have a huge shift in the labor market. And if I look at factors that can shift the labor market, I think 2 demographic factors are working against that equation. One is immigration policies, and the other one is like the newer generations, right? Like hopefully when the students from Drake University all graduate and go to the labor force, then perhaps that will increase the labor force participation rates. But at the same time, we are dealing with an aging populations that baby boomers are leaving the markets, leaving the workforce. Now, granted, this economic crisis that we're seeing right now perhaps would delay their retirement age for a couple of years. Maybe not. So when I look at all of those things, like it seems like the arguments are stacked against a weaker labor market, or it's weaker may not the right word. It's stacked against the fact that unemployment rates can really surpass 5% and 7.5%. Like I hate to say it, I hate to see people lose jobs, but going from a 3.5% to 4.5% or to 5% unemployment rate, I think the Fed's tolerance for that is actually pretty high. I think that they're willing to let unemployment to get up to 5% before they would blink. So for that reasons, in our range of outcomes, what we're trying to analyze is that in that environment, when consumers are holding off better than corporations, then is there a reinvestment assumption or is there a reallocation that we should be investing more on asset that's consumer based than it is corporate based? That's kind of how we're trying to take into consideration in our investment decision making process.
Yeah, one of the things that I remember is grad school, and when I was in grad school, economics natural rate of unemployment that we were taught was 6%. So we're not even there yet, right? So you can argue things have changed, but yeah. Any other questions?
What's for lunch?
So there are no other questions. Then please join me in thanking Gary for an insightful presentation. Thank you, Gary. Very much.
Thank you all. We will take a 1-hour break.